How can you pass on your property investments onto your children in the most tax-efficient way? We're often asked this question by investors who are starting to think about their future estate. If you intend to pass on your property investments to your family in the future, it's worth planning for inheritance tax with your accountant. In this video, we'll cover the key concepts of inheritance tax and the different liabilities for personally and limited company owned property. I'm James Poyser. I'm the CEO here at Provestor, the property accountants, and we're here to help you with all things property tax. Firstly, what is inheritance tax and how much is it? Well, inheritance tax is a tax based on an estate's value after a person has died. The standard inheritance tax rate is 40%, and this is charged on the part of the estate that's above the threshold of £325,000. For landlords who own their properties personally and have spent years building a portfolio, this could prove costly for their family after death. The good news is there are reliefs, exemptions and reductions available to reduce the rate of inheritance tax that's due. It's certainly worth having a conversation with your property accountant to plan for inheritance tax and make the most of the exemptions available for your specific circumstances. An option that many investors choose is to give away property to their family as a gift. There are certain rules around inheritance tax and gifting, including the 7-year taper. No tax is due on any gifts you give if you live for 7 years after giving them. If you die within 7 years, you'll need to pay inheritance tax on a sliding scale. And essentially, the earlier you make the gift, the less tax you pay. Before we continue, I just want to call out some free resources that you might find useful. Head to the description below and you'll find links to our expert guides, calculators and fact sheets, all of which are freely available on the Provestor website. Check them out and let us know in the comments if you found them useful. So what about limited companies? Property held within a company gives more options when it comes to planning for inheritance tax. If you plan to pass your business on to your family in the future, it's much simpler to transfer limited company shares than a personally owned property. In this circumstance, as the property remains owned by the company, it could also be protected from stamp duty, inheritance tax and capital gains liabilities. There are lots of options when planning for inheritance tax. We recommend talking to a specialist property accountant to find a strategy that meets your needs. And here at Provestor, we've helped many clients plan for their future. Why not book a call and see how we can help you? Thank you for watching this video. I hope it's been a useful overview of inheritance tax and estate planning. If you found this useful, please like our video, subscribe to our channel, and if you have any comments, please drop a comment below. I hope you've enjoyed the video and I'll see you in the next one.